Welcome to Earnings Roundup. Today we are looking at Webull's Q3 2025 results, and the top line figures are, well, they're pretty exceptional. We're talking $156.9 million in revenue, up 55% year over year, and a huge EPS beat. 7 cents against a forecast of 3? I mean, that's a 133% surprise.
Those numbers are outstanding, absolutely. But here's the puzzle you have to solve right away. The stock, it initially popped, 4.01% in aftermarket trading?
Yeah, a healthy jump.
Only to completely reverse and end up trading down over 5%. So our job is to figure out why the market is so conflicted when the numbers on the surface look so good.
That's the central question for sure. So let's start with the metric that really drives that efficiency story. Profitability. This report shows a massive shift.
It really does. I mean, this quarter is maybe the clearest evidence that Webull has crossed a major operational inflection point. Their adjusted operating profit hit $36.7 million. That gives them a 23.4% adjusted operating margin.
And when you compare that to a year ago,
That's a $42.1 million improvement year over year. They basically went from a loss to this.
that's a huge swing. And they booked, $32.9 million in adjusted net income this quarter. So what really powered that? It has to be the leverage in the business model.
Exactly. You look at the P&L, revenue soars 55%.
Okay.
But then you look at the expense side. Their adjusted operating expenses only grew 13% year over year. Just 13%.
And that divergence is critical. To grow your top line almost 5 times faster than your costs, it just proves the scalability.
It does. It shows the infrastructure they've built can handle way more volume without them needing to throw more money at it. The question is this a structural change or a one-time thing?
It feels structural, doesn't it?
I think so. It shows they've hit a kind of critical mass where the cost to add one more user or process one more trade just drops. If they can keep that discipline while expanding, the market has to reward that eventually.
Okay, so let's break down that revenue. Trading-related revenue, that's payment for order flow, options, all that, was up 64% year over year. Very strong.
It is. And that 64% is the core engine.
Right.
But it's important to remember, this isn't just, simple stock trades. It reflects the complexity of what's happening on the platform.
Right.
Webull's user base is sophisticated. They're trading options, using margin, short selling, and the platform gets rewarded more for that kind of activity.
And the other side of that, the interest income grew 32% to $43.4 million, which is tied directly to client cash balances.
Yeah, the higher interest rates are definitely a tailwind for them, but you have to earn that interest. You have to get the client assets on the platform in the first place.
Which is the perfect transition. Let's talk about the drivers behind all this, the customer metrics. This is where the real thesis is.
It is. So customer assets hit an all-time high, $21.2 billion. That's 84% growth in just 1 year.
Wow. 84%.
It's explosive. Now, we do have to segment that a little. About $1.2 billion of that came from the Webull Pay acquisition.
Okay, so that was an inorganic bump.
It was. But even if you strip that out, the organic growth is still incredibly strong. And it's not just passive growth. Net deposits were $2.1 billion in Q3, up 31%.
And they also said October was a record month, right, for deposits volume.
But the revenues, that momentum is key. It shows Q3 wasn't a fluke.
And all those deposits translate directly into activity. Equity notional volume. It surged 71% to $204 billion.
And options contract volume was $147 million, which is up 24%.
So the question with that 71% surge is that existing power users trading more because of volatility, or is it new users forming habits? You want it to be sticky.
Exactly. But their strategy suggests they're focused purely on that stickiness.
Yeah.
They ended the quarter with 4.93 million funded accounts, a 9% increase. But the really interesting part is this shift in their marketing. They're moving away from just giving out free stocks.
Toward quality over quantity.
That's it. Free stocks get you signups who might never deposit a dime. Now they're doing asset matching promotions. They're incentivizing people to bring real sticky assets over.
So they pay a bit more upfront to acquire a much higher value customer.
Exactly. And the ROI on that is way better long term. And it's working. Their quarterly retention rate is still incredibly high at 97.7%. Once they get you, you tend to stay.
All right, let's shift to the product innovations. This is where they're building their moat for the future. What's actually driving all this engagement?
The biggest one, with the most immediate impact, was relaunching crypto trading in the U.S. back in August.
And the adoption was immediate.
It was a massive win. Over 50% of their new funded accounts are immediately trading crypto.
50%. right out of the gate. That tells you everything about who their new core customer is.
It really does. And now they're planning aggressive pricing in 2026 to capture more of that market. They're aiming for 100 token listings.
A clear shot at the competition.
For sure. But we also have to talk about Vega. This is their in-house AI-powered decision tool.
Right, the thing that analyzes news, earnings, technicals, all to give you personalized insight. They're calling it the future of investing.
And the impressive part is the cost. Because they built it all themselves, they claim there's almost no external cost to run the AI.
But they're seeing tens of millions of engagements from it.
Phenomenal engagement. This is a real competitive advantage. Their rivals either have to pay a fortune in licensing fees or spend years trying to build their own.
But is it really zero cost? I mean, you still have engineers, cloud infrastructure. Are those costs just hidden somewhere else?
Well, it's not zero cost to build, but it's near zero marginal cost to deploy. Once it's built, sending an insight to 1 million users costs about the same as sending it to 10 million. It reinforces that margin expansion story we talked about earlier.
Okay, that makes sense. Now, shifting gears a bit, the sleeper hit here might be the prediction markets.
I think you're right. They launched this with Kalshi, letting people trade contracts on sports, on real-world events.
And the numbers are kind of crazy.
They're eye-popping. 30 million prediction contracts were placed in October. That's nearly double September's volume.
It's a brilliant move. It's a way to re-engage dormant accounts, maybe from the GameStop era, with something that feels more like gaming.
It's gamification to solve a real business problem. And it's a new revenue stream. They make about 1.50 cents per contract. But more importantly, it's a funnel. A user comes back for an NFL game and suddenly they're back in the trading ecosystem.
We should also mention the other products like corporate bonds and Webull Premium, which is at 90,000 subscribers already, ahead of schedule.
Right, they're diversifying across the board.
Okay, let's zoom out to the global strategy. Management calls it a single global vision, localized execution. And with 14 broker-dealers worldwide, this is critical for growth.
The expansion is just relentless. They entered the EU through the Netherlands in September, and they're being really smart with a B2B strategy in some markets.
Like in South Korea.
Exactly. Their partnership with Meritz Financial Group lets them access that market immediately without going through the whole process of getting a local brokerage license.
And that institutional B2B revenue gets baked into their transaction volumes, which makes their numbers more resilient.
And you're seeing real milestones. Webull Canada is about to hit $1 billion in assets.
Yeah.
But here's the key stat.
Go on.
New funded accounts from outside the U.S. are now roughly equal to new accounts from inside the U.S. That's a huge pivot. International growth is set to outpace domestic.
So if you put all this together, the efficiency, the focus on sophisticated users, the global expansion, what's the outlook? They're guiding for almost $690 million in revenue for FY 2026.
It's a bullish outlook. They're going to push hard on crypto, on those B2B partnerships. Of course, they're open about the risks. Competition is fierce. Crypto regulation's a wild card.
And market volatility. But their argument is that their platform is kind of built for volatility. Their users trade options, they short sell, volatility is their friend.
That's a crucial point. They aren't just relying on buy and hold investors. Their traders are active. They see opportunity in down markets, which makes Webull's revenue less tied to just the S&P 500 going up.
Okay, so to wrap it all up for you, Webull delivered record revenue. They hit this breakthrough profitability by keeping a lid on expenses, and they did it all while investing heavily in AI, crypto, and their global footprint.
And yet, we come back to that central tension. Despite all these operational wins, the stock dropped after hours. Investors are maybe questioning if the growth rate is sustainable, or maybe it's just broader anxiety about fintech valuations.
Their strategy seems clear, though. They're exporting that sophisticated U.S. retail trading experience, options, data analysis to the rest of the world. That's their differentiator.
Which leaves you with a really interesting final thought to chew on. Webull says their AI tool, Vega, is the future of investing. At the same time, half their new users are jumping into crypto. So what is the future here? Is it about using AI for sophisticated market insights? Or will these high-engagement, high-volume prediction markets, the stuff that feels more like entertainment, be the real engine that drives the next wave of account growth? That tension between sophisticated tools and mass market engagement, that's what you need to be watching.